Welcome everyone to today's presentation. We are very pleased to have you join us. My name is Eric Reschner with Regatta Research in Money Management. I'm a fee-only financial advisor and financial educator, and I'm joined today by my colleague, Rudy Blanchard. Rudy and I and our entire Regatta team are excited to present this webinar. And it's become even more timely with all of the potential tax changes that are potentially coming down the pipe. Now, before we get underway, there are a few key points that we'd like to bring to your attention. First, needless to say, there is no perfect fits all tax management strategy. Every choice has its limitations, its benefits, its trade-offs. In this presentation, Rudy and I are going to provide you with important information about 8 key topics. If you do have any general tax-related questions throughout the presentation, we want you to please feel free to ask. You don't need to wait towards the end. A chat box will be on the right side of the screen. And if you're watching us on a mobile device, it'll be right at the bottom. Chances are that if you have a question, someone else will be wondering the same exact thing. So if anything comes up, please ask us right away. And as a quick reminder, we're going to be, needs to say, unable during this presentation to answer questions about your specific tax situation. But we are, as always, more than happy to answer any general tax-related questions you may have throughout this presentation. Now, before we do a deep dive into the taxes, you need to know where we're coming from, a little bit about the history. The very first income tax in the U.S. was proposed way back in 1814 to help fund the War of 1812. We all remember the Battle of New Orleans, of course. But that tax never happened because the Treaty of Ghent ended hostilities between the U.S. and the U.K. in 1815, which meant that the U.S. no longer needed the extra revenue. The first actual classic income tax that we think of today went into effect after President Lincoln signed the Tax Act during the Civil War way back in 1862. This law set 3%, which sounds very low to us today, on incomes above, even more so, $600, and 5% on incomes above $10,000. Records show that very few Americans, unlike today, actually filed their taxes back then. The Tax Act of 1864 raised taxes to continue funding the Civil War. Following the Civil War, with the need ending, of course, the public began to lose interest along with a need to pay for income taxes. There were several attempts to make these tax acts permanent, but they failed following, and this may sound familiar, complaints from business leaders and many individuals that it would hurt growth and put money into unproductive government spending. Then in the 16th Amendment came along in 1913, giving Congress the authority to tax American citizens' incomes. Tax rates, of course, have fluctuated significantly over time as the income needs of the federal government have fluctuated along with it as well. Individual income taxes accounted, catch this, for less than 1% of GDP in the mid-1930s, even following the Great Depression. But during World War II, they reached as high as 9.2%. The White House's Office of Management and Budget, the OMB, estimates that individual income taxes will total 8.3% of GDP this year and will rise to 8.8% by 2025. And if our fiscal spending continues, we may see it even rise greater than it was during World War II. At the end of 2019, the U.S. government collected $1.7 trillion in individual income taxes. And during the 2020 election, needs to say there was a lot of discussion about what our tax structure will look like in the near and intermediate term future. Needs to say, myself, Rudy, and your entire Regatta team is continuing to receive a lot of questions from clients and friends of Regatta about what are we going to do about income taxes, what are the rates going to be. It's important to keep in mind that these changes take time to implement, and we often have a very long runway before we need to implement with specificity proactive tax changes. But needless to say, we would anticipate some potentially significant changes, if not in the near term, but potentially over the long term to our tax policies. Elections have consequences, as they say, but we do have time. But we're going to start laying a foundation, a framework for what are the moves, what are the foundations, what's the history, what's the general structure, so you have the knowledge in conjunction with us to work with you to make sure that any additional tax burdens do not fall too heavily on you. Now, the importance of doing advanced tax planning and learning more about how taxes work become even more critical in the near future. This is due to the massive fiscal deficit spending by the U.S. government. This will have to start being paid off at one point, either presumably by higher taxes and or a combination of higher inflation. To put this in perspective, how significant it actually is, this chart shows the annual year-over-year percentage change in U.S. government tax revenue in light blue versus revenues, and you can see the difference between them. These two lines are apart like they are now. The difference is significant. The gap between revenues and expenses is huge, and we don't see any real change in that. There will be moderation, but the gap will remain. Now, the profligacy of the recent federal government spending is even more pronounced, and the tab that would have to be paid by taxpayers and unfortunately future generations becomes even more alarming when we put it in historical context. As a percentage of GDP, spending by the U.S. government on COVID-19 was more than either World War II or the Great Depression. COVID-19 was bad, but it pales in comparison to the existential threats that this country faced in World War II, or certainly with the Great Depression. The debt to GDP ratio rose for the first time in recent years above 100% and will soon surpass the post-World War II peak to peak to reach the highest levels in U.S. history. As of March 1st of this year, the U.S. Treasury's official figure for the debt of the federal government rose to $28 trillion. That's a huge number. To put this in context, at current levels, and of course it's continuing to grow, that translates, again at current levels, to $84,834 for every living person in the United States. Now, viewed from this perspective, the current fiscal situation and the prospect for long-term rates, frankly, looks rather worrisome. So far, we've just discussed the federal deficit and what it might mean for individual tax rates. That's going to be our focus today. However, corporate tax rates may also be raised. And you can see the chart on the left from a historical perspective. Corporate tax rates are currently fairly low, and they've trended lower over the course of time. They may start to rise, we predict, as well. Now, any increases in corporate tax rates will, of course, help to reduce our federal deficit. However, and this is more of a discussion for another webinar in the future, this may result in lower earnings on corporations that will reduce the attractiveness of stocks and start to knock out one of the major tailwinds behind the strong stock market appreciation many investors have experienced over the years. Now, let's turn back to our personal tax rates. Look at this chart. We can see the marginal tax rate on top earners has varied over time. In 1915, and go to the far left, it was at 7%, which sounds very low these days. After World War II, the marginal tax rate jumped all the way up to 94%. Hugely high and also counterproductive for growth. This wound up dropping slightly in the years after the war, but it rose and stayed high throughout the 1950s. Now, despite being at 50% for most of the 1980s, it dropped and stayed at 28% for 3 years before the late 1980s, before rebounding back to 39.6% in 1993. The highest marginal tax rate dropped a little in the early 2000s, and then the 2017 Tax Cuts and Jobs Act reduced the tax rate on the highest earners to 37%. And it's currently scheduled to stay at that rate until December 31st and 2025. That's something for all of us to keep in mind. That window may start to be closed at one point. But again, we'll do a little bit deeper dive into this as far as what the implications may be and as the timelines for all of us to keep in mind. Now, the U.S. federal tax system is progressive, meaning that tax rates increase as your taxable income increases. The lowest income earners pay oftentimes no federal income tax, whereas the highest income earners pay a significant portion of all income taxes collected. Overall, income taxes cover nearly half of all federal revenue. Here's a few did you know highlights about the tax system that Rudy and I put together to keep a few things in perspective. Americans who earned less than $30,000 per year, which is about 40% of all tax returns, paid only 1% of all federal income taxes in 2018. And by the way, we use 2018 because that's the most recent data that the IRS provides to us. And did you know that Americans earn more than $200,000 per year, which is only 5.6% of returns, paid over 60% of all federal taxes in 2018, and Americans who earn more than $2 million but under $5 million paid 7.5% of all federal taxes in 2018. Something to keep in mind when you hear about a fair tax burden. The higher incomes pay a significant amounts more than anyone else already. Unfortunately, looking through our crystal ball, and this is, of course, is unclear in the future, this may become an even higher burden on higher income earners in the future and make tax planning even more important part of your financial plan and strategic planning. But don't worry about that. Your whole Regatta team is here to lay that out for you in advance with the game plan to make sure you minimize it as much as possible and keep more in your pocket while being fair and, needless to say, ethical and legal. Now, what might we be looking at on a cursory basis? President Biden said during a recent interview on Good Morning America that, quote, anyone making more than $400,000 will see a small to significant tax increase. He did add that if you make less than 400,000, you won't see, quote, 1 penny in additional federal taxes, end quote. He needs to say your regatta team is keeping a very close eye on this for you. Our agenda today are learning outcome statements. Rudy and I are going to discuss 8 specific tax strategies and tax issues for you. First, we're going to review the current tax rules. Everyone remembers the 2017 Tax and Jobs Act, which brought about big sweeping changes to the tax code. Most of those changes, the good news, are still in effect, but there are a few changes that we're going to highlight to you. Next, Roth conversion opportunities in 2021 and how to do them right. Third law, health care tax changes and the associated opportunities they present themselves. Then distribution actions. Fifth, tax smart asset allocation techniques. We call that asset location. What assets and what investments and what accounts. Then gift tax exclusions, treasury securities and tax exempt municipalities and the savings advantages they can create for you. And finally, doing good while reducing your taxes, giving appreciated assets to charity. We've got a lot to cover, and we've got answers and time to answer your questions as much as possible. If we can't get them to all, we're happy to speak with you individually after this webinar to make sure that you're taken care of. So hit us up now during the webinar or after. Regardless, Rudy and I and your whole regatta team are there for you. Number one, let's highlight the tax changes, the key ones in 2017. Now, what did they do? What do we want to highlight? For the 2021 tax year, the standard deduction is $25,100 for joint filers, $18,800 for heads of household, and $12,550 for single filers. The state and local tax, known by the acronym of SALT, now has a $10,000 cap. The child tax credit stayed at $2,000, and the phase-out increased to $400,000 for married couples. The limits for deducting mortgage interest for buying, building, or improving your home stay the same, with a maximum of $750,000 in principal value. Now, here are a few more items that were introduced in the 2017 tax cuts and that are still in effect. 529 plans are eligible to fund both elementary and secondary education, important if you're funding private schools. As an aside, keep in mind that with 529 plans, it's important to not just look at it at the general federal level, but the implications can vary significantly from state to state. 2 levels in the 529 plan analysis. In some states may provide advantages and benefits exclusively to their residents. Withdrawals from tax advantage saving plans that are not used for education are subject to ordinary income taxes and may be subject to penalties. So be very smart about your sources of this. We want you to avoid taking 529 plans if it doesn't meet the enumerated list. In general, Rudy and I recommend that you consult with legal or tax professionals for specific tax information for your individual situation. A few other key takeaways. You can no longer reverse a Roth IRA conversion. Once you do it, you cannot go back. Now, here's something to keep in mind regarding your eligibility for Roth IRA contributions. The adjusted gross income, or AGI, phase outs have risen for 2021. Good news. For single filers and head of households, the range has increased from $125,000 to $140,000. For married filing jointly, it's increased as well from $198,000 to $208,000. Both nice increases in both situations. And to qualify for tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and must occur after age 59 and a half. Now, tax-free and penalty-free withdrawals can be taken under certain circumstances, such as the result of the owner's death, and the original Roth IRA owner is not required to make minimum annual withdrawals, which makes it good for later years as well. The AMT, or alternative minimum tax, increase in 2021. The exemption for married couples, married filing jointly, has increased, which is also good news as well, to $114,600, and the phase out is increased to $1,047,200. For the very affluent, the estate tax exemption has increased to $11.58 million in 2020, and individuals bidding from the adjustment may want to reevaluate their strategy they have in place to address any tax and liquidity issues related to their estate. And in 2021, the tax exemption has increased even higher to $11.7 million. So if you have a very large estate, this is a concern, this is good news. However, we would anticipate that as the federal government starts to look for sources of revenue later on down the line, this may potentially become one of their targets, and we would anticipate that their threshold start to be decreased. But again, we haven't seen anything just yet, but something we have our radar screen highly attuned to at Regatta. Now, this is the timelines that I intimated about earlier. To stay within, at the time, the 10-year budget of $1.5 trillion, lawmakers scheduled many of their 2017 tax law changes to expire. This creates multiple critical timelines that Rudy and I want you to be aware of, so these windows don't close on you and you miss out on them. Some of the key provisions have already expired in 2018 and in 2019, while others, a few of us I've already shared with you, are set to expire in 2025. So we have a little bit of time. This table we put together for you shows how they're structured. Let's do a deeper dive and take a look at a few of the critical ones. The 2017 Tax Cuts and Jobs Act was a very far-reaching overhaul of the U.S. tax code. Many of the changes targeted businesses, including a reduction in the top tax bracket from 35% all the way down to 21%, greatly increasing the revenues of corporations and increasing our compatibility versus foreign corporations. Now, the Tax Foundation's tax and growth model projects that our GDP could increase by 2.86% over the next decade due to these reductions on corporate taxes, or an average of 0.29% per year as a result of the 21% tax bracket, greatly improving, again, the compatibility of U.S. corporation versus overseas corporate competitors, which on an aggregate basis have lower corporate tax rates than the U.S. For individuals, the most important takeaway is that many of the tax rules are set to expire in December 31st, 2025. We can't stress this enough. That window is currently open, and we want to take advantage of any opportunities between now and then if they expire, or if they're even changed between now and 2025, because the Biden administration may, and it's only prudent to look at what may be coming down the pipeline, may look to adjust some of these before 2025. Again, remember, these legislative changes, if they do occur, and they're purely hypothetical at this point, take some time, and it remains unclear what those initiatives will be. But rest assured that your regatta team is here to stay on top of them, communicate them, and work with you to take advantage proactively of any changes that may occur. For investors, this is one of the big tables we want to spend some time on. This is your long-term capital gain tax rates. Particularly important due to the fact that many of you have experienced fairly significant increases in your accounts across many asset classes over the last few years. Let's take a little dive into these rates. The highest earning taxpayers pay a 20% tax rate on long-term capital gains. Those in the lower tax brackets will pay either 15% or 0%, depending on their incomes. Please note that because we have clients in many states, we didn't put the individual rates, if any, that the state will put on them. So you need to factor that in as well when you're doing the calculus. As a reminder, you must hold a security for at least 12 months to qualify for the lower long-term capital gains tax treatment. Short-term capital gains are those that you hold for less than a 12-month period, and they're going to be typically higher, taxed at your ordinary income tax rate. As a side note, ordinary dividends are treated as ordinary income, and hence also have typically those higher tax rates applied to them. Qualified dividends are subject to the same 0%, 15%, and 20% tax rate, again, that it goes to those long-term capital gains, something that we sometimes see trips up on the unwary. Keep in mind that this guide, this webinar in general, is meant for broad informational purposes only, not for real life advice applied to your specific tax situation, which can be fairly involved and fairly complicated. So make sure that you consult with your tax, your legal, and accounting professionals before modifying or setting in motion any of the tax strategies that we share with you throughout this educational webinar. Now, one way to manage and potentially reduce investment-related taxes, and consider taking advantage of your tax deferred account. Those are your 401k plans through your employer, IRAs, annuities, or health savings accounts, also called HSAs. These accounts have the potential for tax deferred growth, which could significantly, over the course of time, increase their returns on your account even after you pay taxes on them on the back end. You could also manage your tax liabilities by revisiting your asset allocation strategy and shifting your investments that generate taxable income for your taxable accounts. Municipal bonds, depending on your tax bracket, since they're exempt from federal tax, or a classic strategy. Municipal bonds may also be free of state and local income taxes for investors who live in those areas where that potential municipal bond was issued. If a bondholder purchases shares of a municipal bond that invests in a mutual fund that is holding bonds outside of the state where you reside, keep in mind that you may have to pay state income taxes for those bonds that are outside of your state. Also, some municipal bonds may have to pay alternative minimum taxes, AMTs. So we want to make sure that if you're buying muni bonds, check, and we do that for our clients, to see if they're subject to AMTs. That could be a surprise for the unwary. It's important that an investment strategy, as I say, should reflect your goals, your risk tolerance, and timeline. And as important as taxes are, they are only one factor among many when creating an investment strategy. We mentioned a couple other specific products that can be important in managing tax. But here's some additional information to keep in mind when managing these choices. Municipal bonds are subject to a variety of risk, including adjustments in interest rate risk. Interest rates are rising now. The value of new bonds are worth more because they're at higher rates, and older bonds at lower interest rates are worth less. So the value of older bonds can go down in value. They may be subject to what's called call risk, market conditions, and for lower quality municipal bonds, what's called default risk. Now, also, municipal bonds issued by certain municipalities may be difficult to sell as well. And a municipal bond issuer in certain areas that are low quality, certain states, certain cities, may potentially default on those bonds as well. And if this occurs, that municipal bond may have little or no value associated with it. Under the Secure Act, under most circumstances, you must begin taking RMDs from your 401k plan or traditional IRA or other employer-sponsored plan in the year you turn 72. These withdrawals are going to be taxed as ordinary income, and if taken before 59 and a half, any withdrawals may be subject to a 10% federal income tax penalty, which we want you to avoid at all costs if possible. Now, if you consider an annuity as another tax-deferred vehicle, the guarantees of these annuities are also subject to the issuing annuity company's claim paying ability. So annuities are not, they may say they're guaranteed, but they're also subject to the credit quality of the insurance company as well. And these annuities can have contract limitations, fees and charges and accounts and administrative fees, underlying investment management fees, what they call mortality and administrative expenses, and other charges for optional benefits or riders. So again, this emphasizes the point that Rudy and I want to hit home. Tax savings, tax deferred investments can be attractive, but there are other offsetting variables. Don't let the tax tail weigh the investment dog. Now, HSA is another investment, another tax saving vehicle that we like a lot. If you're under age 65 and you spend money from your HSA on non-qualified expenses, which are ones that aren't approved for non-healthcare expenses, you're going to have to pay ordinary income tax on your withdrawals and pay a 20% penalty, something we want to keep you avoiding. Also, and after age 65, qualified withdrawals for medical expenses are not taxed. And non-qualified withdrawals are treated like income and may be subject to a tax. They're not subject to RMDs once you reach 70 and a half. So we very much like HSAs as a tax savings vehicle. Now, good news. Let's take a deeper dive into 401ks and traditional IRAs. Catch-up contributions went up slightly this year, but there was no change in the regular contribution limits. Taxpayers can now contribute up to $19,500 for their 401ks, 403bs, most but not all of the 457 plans, and those federal thrift saving plans, the TSPs, in 2021. The catch-up contribution for employees 50 years or older has increased to $6,500. Now, the limit on IRA contributions stayed the same for 2021 with a maximum amount of $6,000. Individuals age 50 or older can make a catch-up contribution of an additional $1,000, which helps out, at least on the margins, if you're trying to catch up and save more for retirement. Remember that you have until April 15th of this year to make a contribution for 2020. So if you haven't made it yet, it's not too late to get that money in. If you would like to do this, let your regatta team know if you need any assistance with it. That window has not closed for last year, and it is still open. As you consider your choices, remember what we discussed a few slides ago. Under the Secure Act, under most circumstances, you must begin taking RMDs from your 401k, traditional plan, or employer-sponsored plan in the year you turn 72 and a half. Some of you who are just turning 72 and a half or on the cusp of it may not have done this before. You may have questions about how this works. Don't worry. As a regatta client, we handle all this for you. We walk you through step-by-step and take care of it. So that's one less thing that you don't have to worry about. Also, contributions to a traditional IRA may be fully or partially tax deductible depending on your individual circumstances. Now, we will see slight changes to IRA deduction limits in Roth IRA cutoffs. The tax deduction for traditional IRA contribution phase-out limits depends on your filing status, of course, and your workplace retirement coverage. Do you have a retirement plan at work or not? If you're single and you do have a workplace retirement plan, it's $66,000 to $76,000 with an increase of $1,000 on both ends. If you're married and filing jointly and the IRA contributor has a workplace retirement plan, it goes from $105,000 to $125,000. Married, filing jointly, and the IRA contributor does not have a workplace retirement plan, but their spouse does, it's from $198,000 to $208,000, which is a nice increase from the prior range of $196,000 to $206,000. The adjusted gross income, or AGI, phase-outs for Roth IRAs had a nice increase for 2021 as well. They're as follows: single and head of household increase from $125,000 to $140,000. Married filing jointly also had a nice increase, $198,000 to $208,000. If you own those margins, that could make a difference. And if you didn't contribute before, You may be able to if you fall into that range. So don't leave that opportunity off the table based on the prior limits. Now, to qualify um, for a conversion to a Roth IRA, the IRA, if you consider this option, must have been in place for at least 5 years, and the distribution must take place after 59 and a half, or due to death, disability, or first-time home purchase up to a lifetime maximum of $10,000. And state law has a role in this as well. In some states, Roth IRA distributions may also be subject to state taxes. This is why this is a multi-tier level analysis, and you need to work in conjunction with your tax preparer. The individual retirement account rollover IRA limit rule remains in place for 2021. This rule was set up in 2015, and many people we find forget about this. Taxpayers allowed only one rollover from one IRA account to another during a 12-month period. No, this applies no matter how many IRAs you have. Some people forget about this, so I like to include this as a reminder that you don't run afoul of this. Now, under the Secure Act, in most circumstances, once you reach age 72, again, you must start taking any RMDs from a traditional IRA. Withdrawals from a traditional IRA are taxes ordinary income and if taken before age 59 and a half, again, they're subject to a 10% federal income tax penalty. We want you to avoid this if possible at all costs. Under the Secure Act, you can continue to contribute to a traditional IRA past 70.5 as long as you're meeting the earned income retirement, i.e. you're working. So don't forget about that. That's still on the table for you if you meet those requirements. Now, this rule doesn't apply to what's called a trustee-to-trustee transfer, in which you don't directly receive the money. It also doesn't, for example, apply to a Roth conversion or rollover between a 401k and a IRA. The 6-day limit still applies to all rollovers. What this means that is when you withdraw money from an IRA, you have to get the money back into an IRA within that 60-day window. It's pretty narrow to avoid paying taxes and what we consider to be onerous IRS penalties. Now, before you decide on whether or not to retain assets in a 401k at your prior employer or to roll it over into an IRA, this is not a one variable analysis. It's fairly complicated. And we suggest and recommend what we do for our clients is employ multiple variable portfolio analysis to make sure that you're making the best choice possible for you. That includes looking at the number of investment choices. Are there a few, which there typically are, 10 or 20, or there are thousands, which you mostly do when you roll it over? The investment expenses of those funds within that 401k or 403b, typically we often find they're very high, plus administrative fees. Rolling it out, you typically get access to very low cost index mutual funds. So again, that's not always the case, but that's part of the analysis as well. But could it also include other ones? What are the services associated with you? Do you have protections if this is an issue? Creditors or legal judgments? Do you have lawsuits and asset protection that you need to provide an additional shield from? Any RMDs you may have to make, and whether or not you have employer stock that was paid out to you. again, multivariable analysis. Um, what about Roth IRA conversions for 2021? I foreshadowed this discussion in a few of the prior slides. Now I'd like to go and do a little bit of deeper dive for you. This could be potentially a source of tax planning opportunities for certain investors, not everyone, but for some of them, potentially if tax rates go higher in later years. Now, in a Roth IRA conversion, if you decide to go this route, there's where do I pay for the taxes issue. You can withdraw the funds, the money to pay taxes from the traditional IRA you're making the conversion from, and then move the net into a Roth IRA, whatever the remainder is. All future growth and all future withdrawals from that remainder will be tax-free. Another benefit is that once you make that conversion into the Roth, you're not required to make RMDs. This could play a nice role for you in an estate planning strategy. One note is that if you do make a Roth IRA conversion, and to reiterate, I hit on this point before, but I don't want you to forget about it. In the past, you could undo it. Now you can't. If this Roth IRA conversion is something you're considering doing, let me and I know, and this is something that you and your Regatta team could circle back with you and do a proper analysis to make sure this is the best decision for you. A few other considerations. If you want to consider converting a traditional IRA into a Roth IRA, you may not want to do it if it will significantly increase your current tax burden. And if you do want to do it, you may only want to do it in a limited amount, only up to the level that will not kick you into the next higher tax bracket. This is something Rudy and I and the rest of your Regatta team called tax bracket management. You only do a limited amount up to the amount of the next tax bracket. Also, if you do convert from the traditional to the Roth IRA, it's ideal to pay the taxes that are due on that conversion if you have the wherewithal from another fund. Ideally, a post-tax account, say a brokerage account, an individual account that is not tax advantage as much as a Roth IRA is. That way, you have as much as that tax-free growth forever, or according to current tax rules, growing and left over as much as possible. And a Roth IRA may be a good choice for your financial plan, but again, consult with a tax professional to corroborate before making any decisions whatsoever. Now, to make sure you qualify for the tax-free withdrawals or the earnings, and the requirements are that a Roth IRA must be in place for at least 5 years. Remember this. We make sure you don't want to follow this while I'm hitting on it twice. And any distributions from that Roth, in addition to the 5-year rule, must take place after age 59 and a half, with a few exceptions, including death, disability, or if you're buying a home, and it has to be for the first time, a first-time home purchase, but you're limited up to a small amount, only $10,000, and that too is cumulative over your entire life. So it's available, but somewhat limited. And depending on state law, Roth IRA distributions may be subject to state taxes. If you're giving and planning to give to charity, one tax efficient way may be to donate, instead of giving cash, appreciated stocks, bonds, or mutual funds. Donate the assets instead of the cash. That can eliminate, by following the strategy, the requirement to pay your duty to pay capital gains on the sale. That can make a huge difference to the taxes that are paid and what's left over to that good cause, that charity. You may also be able to get a deduction, tax deduction for the property's fair market value if you're giving to what's called a qualified charity. Many people aren't aware of this. At the end of 2015, Congress made the IRA charitable giving tax break not temporary, but they made it permanent for you. This allows taxpayers who are 70 and a half years old or older to make donations directly from your IRA to that charity. Now, taxpayers who are subject to distribution rules can use all or part of their distribution to make, here's the term, qualified charitable distribution. The acronym we want you to be familiar with is called QCD. That's direct to a qualified organization. By doing so, you could get a big beneficial tax treatment. A reminder, again, before I wrap up here and I turn it over to Rudy, that if you have any questions throughout this presentation, please ask. Don't wait to the end. That chat box is at the right of the screen, or if you have any other questions on a mobile device, it's at the bottom. And now I'm going to turn it over to Rudy. Rudy, it's all you.
Well, thank you, Eric. Let's go ahead and move on to item number 3 on the agenda, and that is how healthcare laws may affect your taxes this year. So in 2013, 2 healthcare taxes came onto the books, which affected high-income taxpayers, the Medicare tax and the net investment income tax. Let's start with the Medicare wage tax. As of 2013, high-wage individuals pay an additional 0.9% on wages above a certain threshold. So who's subject to this additional tax is the question. Well, if you're married and file federal taxes jointly, you're subject to a 2.35% tax on your combined wages that exceed $250,000, as compared to the 1.45% tax you pay on wages below that threshold. If you're married but file a separate return, the additional tax will apply to wages that exceed $125,000. For everyone else, the threshold is $200,000 of wages. So let's take a look at an example. A single individual in 2021 with wages of $240,000 would owe a tax at a rate of 1.45% on the first $200,000 of wages and a rate of 2.35% on the remaining $40,000 of wages for that year. It's pretty simple. The second Medicare tax affects investment income, known to many of you as unearned income. So before 2013, you didn't have to pay a Medicare tax on investment income. But with the net investment income tax, certain high-earning investors have to pay an additional 3.8% tax on income received through passive investments. So people who have to pay this tax include individuals whose modified adjusted gross income, AGI, is above $200,000. People who are married filing individually with an AGI above $125,000, and for couples filing jointly with an AGI of more than $250,000. And of course, some estates and trusts are also subject to this tax. So if you're involved in any of that, you certainly want to contact your tax professional to see how that works for you. Now, the tax itself applies to many types of investment income, including dividends, capital gains, rents and royalties, non-qualified annuity income, for example, and of course, any business income that is considered a passive activity. The tax does not include retirement plan withdrawals, Social Security benefits, and several other types of income. Now, these particulars are certainly complex, and again, we're going to say this repeatedly throughout the presentation. When it comes to tax questions, contact your CPA, your bookkeeper. They can certainly expound on your individual situation. If you spend a relatively large amount of money on healthcare related services, you may be able to deduct those expenses from your taxes. For 2021, you can deduct medical, dental, and other healthcare expenses that exceed 7.5% of your adjusted gross income. Now, these expenses will include those associated with diagnosing, treating, or preventing diseases, prescription drugs, of course, some insurance premiums, medical equipment, and even the travel costs for your appointments to receive those treatments. Now, again, keep in mind, anything that's reimbursed to you is generally not deductible. Once they give you the money back, I don't believe the IRS would allow you to deduct those expenses, but check with your tax professional in that regard. Now, let's take a look at some of the details you should consider when taking retirement distributions. Another way to help keep more of your hard-earned money is to think about how taxes affect your income strategy. So here's some ways to potentially avoid tax pitfalls when taking distributions. So first step, you want to inventory all potential sources of retirement income. This list might include all your retirement accounts and any accounts you manage yourself. Secondly, review the tax treatment for each item and how a change to your income sources would affect your taxable income. An example of this would be if you move money from a taxable account to a tax-deferred account, obviously you're delaying the taxes on that distribution. You want to determine whether you should consider adjusting your asset allocation to move assets into tax-deferred accounts or maximize your contributions to reduce your reportable income. Many of you participate in 401k plans. As you know, the more you deduct from your paycheck to defer to that 401k, the less reportable income you have for the year. So keep in mind, asset allocation is an approach to help manage investment risk. Asset allocation does not guarantee against investment loss. Next, you want to find out the distribution rules for your retirement assets. As Eric had mentioned earlier, under the Secure Act, in most circumstances, you must begin taking required minimum distributions from your 401k plan, traditional IRA, or the other employer-sponsored retirement plan in the year you turn 72. Now, withdrawals are going to be taxed at ordinary income. And if you take it before 59 and a half, it may be subject to a 10% tax penalty on those distributions. You want to create a strategy to minimize taxes now, especially if you fall into the higher tax brackets. And certainly, you want to have a sit down with your significant other and discuss when and how you're going to pass your assets to your heirs. Now, we understand if some of this information seems a bit confusing or complex, so making an informed choice for your distributions is very, very crucial. And another reason you should sit down with a tax professional or a financial professional. Next point, asset location. Now, asset location is not to be confused with asset allocation. But asset location attempts to manage your tax liabilities by taking advantage of the different tax treatments that some investments offer. By using this approach, some investors strive to maximize their after-tax returns by strategically determining which securities to hold in tax-deferred accounts and which to hold in taxable accounts. So how do you know what's best to put in one or the other? Well, a strategy such as this depends on many, many factors, including your age, your time horizons, your risk tolerance, your emotional feelings, and that's just the tip of the iceberg. But if you'd like to explore asset location to see if it's a relevant strategy for you, again, consult your financial professional, and they can help you understand what it means and two, how to implement that strategy. Now let's talk about getting the most out of annual gift tax exclusions, which can be a very, very powerful estate tool. Now, the gift tax exclusion allows you to contribute or give $15,000 to anyone in 2021 without having to use your lifetime gift tax exemption amount. We'll discuss that in just a minute. As long as you limit the gift each year to that year's exclusion, which again in 2021 is $15,000, the Internal Revenue Service doesn't require the giver or the donor to file a tax return. In a sense, no gift taxes will be due. Now, the $15,000 exemption is indexed for inflation and is granted separately to each recipient. Here's an example. A couple has 3 children. The 2 parents could give a total of $90,000 to their children. That's $15,000 to each child by both parents. So you and your spouse can give $30,000 to each child. And again, these gifts do not apply to the lifetime exemption, which is $11.7 million over your lifetime. The recipients of the gifts don't have to pay gift taxes. And of course, any tax responsibility falls on the donor. Now, the simplest way to use the annual exclusions is to give cash or other assets to as many people as you want each year. And even if you give more, you still won't have to pay any federal taxes, at least until you reach the lifetime gift exclusion of $11.7 million. And that's your lifetime gift exclusion for 2021. And you may give more money to individuals by making direct payments to certain qualified medical, dental, and tuition expenses. And these payments don't count against your annual lifetime gift exclusion as long as it's made to the medical institution or the educational institution, not the recipient. That's very, very key when you're gifting to those institutions. So we're nearing the end of our points of discussion, and we just have a few left. And let's move on to highlight Treasury securities and tax-exempt municipals. Now, we could talk a lot about Treasury securities, but for the sake of time, we're going to have the opportunity to discuss a few important points. Now, Treasuries typically offer interest rates lower than other taxable fixed income investments. Many investors choose Treasuries because they're backed by the full faith and credit of the United States government. And as a low-risk investment, Treasury securities can play a role in a diversified portfolio. The government guarantees the timely payment of the principal and interest on Treasury bonds and bills. If held to maturity, they offer a fixed return and a fixed principal value. However, during the course of you holding that bond, the value of the bond is going to fluctuate. Now, of course, Treasuries can also provide some tax benefits. First off, the interest on Treasuries may be exempt from state and local income taxes. So for high income taxpayers who live in states with high income tax, investing in Treasury bills, bonds, and notes has the potential for tax savings. However, you must remember that Treasuries may be subject to capital gains taxes. Of course, if you sell a Treasury at a gain, taxable gain. And as we've mentioned before, the information we're discussing here is not intended as tax or legal advice. So again, go back to the professional, clarify any questions you have for your particular situation. Now, municipal bonds may be helpful for creating tax-free income. As we all know, when you buy muni bonds, you essentially are lending money to a local, county, state, or other government agency. And the government entity promises to pay you interest and in return your principal by a certain date. And the governments use the bond money that you give them for the construction of schools, roads, hospitals, other types of public projects. Keep in mind, and people ask us this question about defaults on muni bonds. Defaults on municipal bonds, it's extremely rare. In fact, over the thousands and thousands that are out there, only 113 Moody's rated bonds defaulted on bonded debt between 1970 and 2017. Between 1970 and 2019, there was less than a 0.1% annual default rate of all municipal bonds. They generate income that may be exempt from federal taxes, and in many cases, state and local income taxes as well. However, not all municipal bonds offer income tax exemptions from federal and state taxes. So if you're doing it yourself, check with your broker to make sure that you're covered in that area. And also that muni bonds are subject to market and interest rate risk if you sell them prior to maturity, meaning that the bond value of that muni will decline if interest rates in the market go up. And the reverse also happens. The bond price goes up if interest rates come down. So you want to pay attention to those economic conditions before you sell that muni bond prior to maturity. So muni bonds are also subject to a variety of risks. Like I said, the adjustment in interest rates in the market, call risk, meaning the muni bond could be called back before maturity, and market conditions in general, as well as a little historically, as we mentioned before, default risk. And Eric touched upon giving appreciated assets to charity. And why did we leave this topic for last? And the reason for that is because we wanted to focus first on helping to ensure your financial house is in order before examining how you support the causes you care about. Ultimately, this is one of our primary goals at Regatta Research and Money Management, to help our clients build financial lives that reflect their values. And of course, we would be remiss if we didn't mention that thanks to certain tax conditions, giving in a proper manner may help you to provide the taxpayer with worthwhile tax deductions. So, giving to charity is probably a whole nother discussion. But when you give to charity, it's a couple of things to consider. The type of property that you're donating, the type of charity matters, whether it's a public or a private charity. And of course, any property donated to those charities, depending on the use of that property, would also determine what kind of deduction. And the deduction is basically a percentage of your adjusted gross income. Whether it's a public or private charity, the use of the gift and how it's going to be implemented in the charity. So there's a lot of factors that go into charity giving. But again, we just wanted to touch upon that to let you know that it's something that's becoming more and more popular as time moves on. And again, if you have any questions about that, hit the Q&A button and we'll try to provide more detail to you in that arena. Now, Eric and I both hope that you've benefited from today's presentation and gained some insights and valuable perspectives on your tax circumstances. Now, we understand that all this tax information may seem complex. Fitting so many new details into your financial vision can sometimes make the horizon less clear. But keep in mind, we haven't even discussed inflation, longevity, risk tolerance, the emotional cycles of investing, the economic cycles of investing, a whole slew of other factors that go into this. We just touched upon it, create an awareness on your side to make you understand that you still have time to act, and now is the time to do it. As registered investment professionals, our job at Regatta Research and Money Management is to help you cut through the clutter and find a path forward. That way you have the ability to build a portfolio that aligns with your goals and values, even as tax laws and market conditions change. So at Regatta Research and Money Management, we will help you in 4 ways. We're going to analyze your needs and goals, where you are now, the goals listed, and see if we can create a roadmap to get you from point A to point B. Inside that roadmap, we're going to help you select suitable investments. We act as mission funds. We're going to put you in the best low-cost funds that are suitable for your objectives. 3, we're going to set realistic expectations. Everybody looks at the market and they're like, wow, the Dow did this, the S&P 500 did this. Why my portfolio didn't do this? Well, everybody's situation is different. So if you're in a balanced portfolio, perhaps a 60% equity, 40% bonds, then it would be unfair to compare your portfolio to the S&P 500. Rather, we're going to choose an appropriate benchmark that measures performance and gives you some guidelines as to how well you're doing. 4th, we're going to monitor your portfolio and recommend changes over time. That's the service we offer. Hands-on, customized approach in managing your portfolio on a day-to-day basis. Now, if you're doing all of this by yourself, we ask that you consider or think about your spouse or significant other if something were to happen to you. Do the two of you understand the differences between stocks and bonds and how they relate to a balanced portfolio? Do you both know how to navigate the maze of tax requirements? And if not, you may want to come in for a checkup and get a second opinion on your financial health. That's part of the services we offer, although our services are not right for everyone, and we are selective about the clients we work with. But we want to ensure we're a good fit for your goals. Even so, we would like everyone to consider the offer of having a review. And during the review, we will take a look at your present holdings and determine whether you are on track in pursuit of your present goals. So Eric and I will make a promise to you. If after taking a look at your present portfolio, we agree with what you're doing, we'll tell you so. However, if we see areas of improvement and ways to put you on a better path to pursue your goals, then we will share our analysis and recommendations or improvements to your portfolio. As Eric had mentioned, the Q&A button is up there on the right of your screen. Type in your question. We'd be more than happy to get back to you ASAP. And we sincerely hope you've enjoyed our presentation today. Thank you very much for your attention. And it's been a pleasure presenting to you. And again, we'll be around for questions, and we will talk to you soon. Thank you.